Very good morning, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes, thank you. So we did bond valuation, equity valuation, and various aspects related to that, and also security analysis. It is basically on technical analysis as far as the syllabus is concerned. Now we are going to portfolio management. Okay, portfolio management. Again, I'm going to give you a full overview, a summary, which might take longer time. So please bear with me. And then we can go for the specifics. So first, I would like to give you the entire chapter overview. Okay, now before we go to the portfolio management, you should understand two important terms. One is returns, the other is risk. It is often said that we should always take calculated risk, but seldom. Many people don't know how to calculate risk. And let me tell you, you cannot avoid risk. You have to manage risk. So, to manage risk, you need to calculate risk. Warren Buffett says risk comes from not knowing. So, if you invest something where you don't understand, you don't know about it, that's how you create risk more. And about risk management, we have a separate chapter and we have a separate subject as well. So in various cases, the risk element keeps intersecting our concepts. So we have to understand how to calculate return, how to calculate risk. We'll come to the formulas. But one of the ways of managing the risk is portfolio. How is that? Basically, portfolio is a group of items, or you can say combination of shares, a combination of investments. I invest in multiple shares rather than one share. Even your life also, you can see various portfolio allocation of time, the way you divide your resources. And the biggest portfolio that you have to manage in your lifetime is group 1 and group 2. That's a portfolio you have. The objective of portfolio is to maximize the return and, more importantly, minimize the risk. This is the primary two objective. We are going to discuss many portfolio theories, but there keep it in mind, these are the two objectives. We want to make sure our return is high and we want to make sure our risk is as less as possible. Just like your expectations in exams, you want to score more marks, but you want to do with less efforts. Similarly, the basic principle is to make a decision about the future. Of course, we don't know the future, so we take the historical data into consideration, and historical data will be many years, many months, many days. How do you convert many into one into expressible number? That's where we use average. Okay, so first let me talk about the concept of risk and return, and then we talk about the concept of the portfolio and portfolio theories. So as I told you, it will be slightly lengthy initially. Please bear with me, but it will give you a good base and overview of portfolio management. So first we have portfolio, or we have three terms here to understand. One is individual security, then we have portfolio, and then we have market. Individual security, Infosys, TCS, Wipro, Reliance, HDFC Bank, Nestle, HUL, individual security. Then we have a portfolio. So I invest in multiple portfolio. I invest in Reliance and I invest in HDFC Bank. that is called as portfolio. But entire security put together, all over India, all the shares put together, that is called as market. So we have to understand in 3 layers how to calculate return and risk of security, of portfolio, and of markets. And it is very interesting. How do you calculate the market returns? How do you calculate the market risk? It's very interesting. I'll come to that. Okay, first let me talk about the basics of returns and then I'll go for risk. Okay, now basics of returns, or we are going to calculate very simple average returns, X bar. I'll just tell you for a security, how do you calculate average returns? Previous year, the stock price is 20 rupees. Next year, the stock price became 22 rupees. Next year, the stock price became, let's say, 25 rupees. So what is the percentage if you want to calculate? Return should always be in percentages. Risk should always be in percentages. This one point you should keep it in mind. Return we can also express in rupees, but I would like to make sure it is expressed in percentage terms. So 20 becoming 22, that is 2 rupees. But 2 rupees out of how much? 2 rupee out of 20 rupees. So returns we calculate the average return summation x divided by n, and return for a security. Return is calculated by, or let's try the formulas. First, let me just tell about the basics. 2 by 20 into 100, I get 10%. Next year, how do you calculate? I will calculate from 22. I don't calculate from 20. 1 year is over. So 3 rupees out of 22. Some number I get. So first year return I get, second year return I get. This I call it as R. X is what I call it, and summation x by n, that's how I get average returns. This is return calculation. Then we talk about risk calculation. Risk is measured by standard deviation. Standard deviation formula is summation x minus x bar the whole square divided by n. This is the formula for standard deviation. What is x value? Individual number. X bar, average. X minus x bar, you get deviation. That deviation, we will square it. We get x minus x bar whole square. We calculate for 1 by 1 and then we add all. That is total summation divided by n, number of observation. Then we do square root. And what is the interpretation of this? Suppose for a security, if return happens to be 10% and standard deviation happens to be 2%, then we say that based on the historical data, this share price is likely to give me in the next year 10% return plus or minus 2% return. We always express estimation like this, right? In a lower number and upper number. We would like to give a range. If the stock is high risky, we give a higher range. If the stock is less risky, we give a lower range. And how do you calculate that range? For that range calculation, we do standard deviation. Higher the risk, higher the standard deviation, higher the range. So it is going to be estimation for future, expectation or estimation will be x bar plus or minus standard deviation. Okay, let me just write it so you can also write along with me. The basics, we have return and we have risk. Returns I'm going to calculate for 3 parts. Return for a security, return for a portfolio, a return for markets. Risk for a security, risk for portfolio, risk for market. Now, returns should be in percentage, risk should be in percentage in this chapter. So, even though they don't specify, one rule we follow: returns we express in percentage, risk we express in percentage. Okay. Then coming to security, I will calculate security or x bar as summation x divided by n, or summation r, whatever you want to say. Return of a security, that is what is x. Return of a security, we write like this: P1 minus P0 plus D1 by P0. You can also express in percentage multiplied by 100. P1, price at the end of the current year. P0, price at the beginning of the year, plus D1, dividend expected or dividend received at the end of the year, whole divided by investment, P0 into 100. Numerator is the profit, denominator is the investment, P0. That is the return for a year. Like this, we calculate for every year and for different securities. And sometimes you will also have probability given. So if the probability is given, x bar is given by summation x into p. We multiply with probability. X value returns, p represents probability. You multiply and do the total, that will give me with probability. This is regarding returns of a security. Regarding risk of a security, we express by standard deviation and the formula summation x minus x bar whole square divided by n square root, and sometimes statistician says we should divide by n minus 1. That's some sample space impact. Let's keep it as n. And if it is with probability, then we have summation, same formula, x minus x bar whole square, but I multiplied by p, probability, and then I get a square root. And standard deviation, one more is also there. Standard deviation square is called as variance. I'll tell you what is that variance impact. And interpretation, that is, we are going to use or usage for x bar plus or minus standard deviation. So will give us the range for estimation purpose. And let me tell you one small difference between standard deviation and variance. This is one area where many people have confusion, where we should use standard deviation, where we should use variance. That is like a difference between length of line versus an area. See, for example, 30-40 site is what we tell, right? 30 is one side, 40 is another side. But what is the area of the site? 30 into 40, 1200 square feet. That length, 30-40, that is standard deviation. And the area, 1200, is variance. What is the significance of this? Standard deviation is used for expression of risk. I have 30-40 site, expression of risk. But variance is used for simplification. If this one site and another site, I want to add it. I want to construct house. How the cost is going to be calculated based on the area. Similarly, if I have portfolio X, I have X security, Y security. If I want to mix, then standard deviation I will not use. I will use variance. So in the exam, if they ask you variance, we also compute standard deviation, because these two are interchangeable terms. Don't be so specific in exams. Interpretation matters. So for safety purpose in exam, you calculate standard deviation, you calculate variance. So one point you have to keep it in mind: standard deviation is used for expression of risk. Variance is used for simplification of risk. If you calculate something further, simplification, you have to do variance. Final answer we express in standard deviation. Hope you got it. Now, coming to portfolio. There is one common statement regarding portfolio by Warren Buffett. Don't put all the eggs in same basket. You can also apply that in your life. Don't put all the money in same pocket because your friend will take away everything. Anyway, so portfolio is about investment in multiple shares, right? Investment in multiple shares. So X share, when you have Reliance, will have HDFC Bank, you will have Infosys. So now all the three will give different returns. I want to mix everything. I am going to calculate that as weighted average. So portfolio, I call it as RP, portfolio returns, given by summation x1, or let's say R1 W1 plus R2 W2 dot. R1 return from one security, W2 return from R2 return from second security, W1 weight in first security, W2 weight in security. How do you calculate weights? The weight here is calculated by the investment in security divided by total investments. You will have number of shares. I invest in 1000 shares into 20 rupee market price. So in that company, I have invested 20,000. Like this, if I calculate for all security, totally I have 1 lakh. Out of 1 lakh, in this security, I have invested 20,000. My weight becomes 20,000 by 1 lakh, that is 0.2, that becomes weight. That is portfolio returns. Now coming to market return, this is a very interesting point. How do you calculate all the stocks market return? What is happening in the market on an overall basis? That we calculate with the help of indices. Like we have in India, Nifty, Sensex. What do? They are the average returns of the stock. For example, Nifty 50 is the uh, average return of top 50 companies in India. Why top 50 companies? Because taking all the companies will be too much difficult to consider. So we take a representative. We believe top 50 companies in NSE to be representative. In fact, they are representative. There might be some 5,000 companies, but out of the 5,000 companies market cap, top 50 companies only 60%. Therefore, we just look at top 50 companies. They represent the entire market. That's what is Nifty 50 and Sensex 30 companies. And the values, you will have the index values, like Sensex points, Nifty points. I told you, they are notional portfolio. Indices are notional portfolio. Indices are notional portfolio. What is the purpose of Nifty? What is the purpose of Sensex? Is to represent what happened in the market on an average basis. On an average basis, so that we understand like a benchmark. Nifty is market, like an average benchmark. So if your stock, what you're selecting, is performing better than benchmark, that is a good stock to buy. You're performing well. You're outperforming the markets. So can I purchase Nifty itself? No. I can purchase Infosys. I can purchase Reliance. I cannot purchase Nifty. It's a benchmark. It's average. It's a notional portfolio. But I can invest in portfolios which replicate Nifty portfolio. They are called as index mutual funds. They are called as index futures. We have ETFs. We'll come to it later. But primarily, can I buy the Nifty? No, it is notional portfolio. It is only going to act as a benchmark. Therefore, if I calculate the P1 minus P0 plus D1 by P0 into 100 for that market, for that index, I will get the market return. So, index return is nothing but market return. Similarly, index risk, index standard deviation is a market risk. So index standard deviation is market risk. So whenever I say market risk, it means index standard deviation. Now coming to portfolio. How do you calculate portfolio risk? For portfolio risk, we have different portfolio theories to understand. We have Markowitz portfolio, we have Sharp portfolio risk. So different people have given different opinion as regards portfolio. So this is one level of summary, and still I'll go for the individual portfolio theory now. If you have any doubts at this stage, please ask, and make sure you have written down these things. And once it is done, I will go to the individual portfolio, portfolio theories. If probability is there, just like here I have given one formula, x bar is summation x into p. P stands for probability here. In some time in problem they'll give you expected probability. So if probability is there, average should be calculated like this. X is return, P is probability, multiply and do the total. And similarly for risk, if probability is there, x minus x bar whole square, same formula like this, but I multiplied by P. P stands for probability. That P, I mean that square root should come there also. Yeah. So this is the standard deviation for calculation with probability. If problem contains probability. And variance, also remember, this is used for simplification of risk. If you want to calculate, mix, revise some performance or mathematical operations you have to do, we'll use variance. Okay, any other doubts? Are you done? Yes, I hope it is done. Okay, next. Before I go to portfolio management theories, one thing you have to understand is a new concept called as, maybe you might be aware of, you're supposed to be aware of, but anyway, I'll do a quick recap, that is correlation and regression. What is the correlation regression? Or why is it required? See, if it is individual security I invest, that's okay. But when I invest in two securities, it is important how they behave with each other. See, you are individual in life. That's left to you. You can live however you want. But when you are part of a society, or when you are entering into a relationship with another person, it's important how you behave with each other, the interaction level. Similarly, if I invest in Reliance and Infosys, so when a news comes, how Reliance behave, how Infosys behave, the interaction between each other, or for a single news, they can behave differently. For a single news, one stock might go up, another stock might come down. For example, if petrol price increase or crude oil price increase, uh, some people like Asian Paints, the share price might fall down because Asian Paints use those products as input cost. But petroleum companies, they can increase the sale price also, so their sales value will increase. So petroleum companies' share price will increase. So how you behave, how you react to each other. For example, if rubber price increase for a rubber company, the share price will increase. But for tire companies, share price will increase because for tire companies, that rubber is raw material cost. Getting my point? Different examples can be given. So how you react for a news, you can react similarly as well. If you belong to same sector, you're likely to give similar reaction, but you can give opposite reaction as well. For example, if Airtel increase their price, if Airtel increase the price, how it can happen? Even Reliance share price it can increase. What the expectation? Oh, if Airtel can increase, all telecommunication will increase. So Reliance also will increase. Or you can say, oh, if Airtel is increasing means they are strong in the market, so they are gaining more subscribers. Airtel will reduce. Reliance will reduce. Anyway, so the point I am to tell is, in portfolio management, we want to understand the behavior between variables. I will call relationship between two variables. Relationship between two variables. We call it as two aspects. One is correlation coefficient. We represent by R. Correlation coefficient, that is R, and then we have regression line. Regression line. So what does correlation does? Correlation expresses two things. One is degree and direction of variables. For example, if I give you 0.8, that means there is 80% chance that both the shares will be moving in the same direction. So if the correlation is positive, same direction. Correlation is negative, opposite direction. One increase or the decrease, like price and demand of a product. Degree means how close. So if correlation is less, lower degree, 0.2, 0.25. If correlation is high, high degree. So in a way, correlation is also, you think, like a probability. So if correlation is minus 0.8, there is 80% chance that the variable can move in opposite direction. So higher the correlation, higher the chance, that is the degree. And correlation coefficient can only lie between -1 to +1. -1 means 100% chance. They are opposite. They are called as perfect negative correlation. +1, 100% chance they will move in same direction. Perfect positive correlation. 0, there is no correlation. But the correlation cannot tell you if one variable moves by 10%, how much the other variable will move by. So correlation, I cannot use it for estimation purpose. It gives me probability, it gives me the direction, but by how much the exact movement, a measurement of movement is not possible in correlation. We come into regression. And in mathematics, if you want to express relationship, that is always by an equation. And equation means when you represent in the graph, that becomes a line. So regression line, or I can also say regression equation. Regression equation. I'll just simply say, let's say y equals ax plus b. Formula I'll come to it later. This is used for prediction. This is establishing relationship. This is establishing relationship used for estimation, predictions, used for estimations. establishing relationship used for estimations. So if I want to estimate something, predict something, I know market return is going to be 10%. What will happen to my security? That will not be given by correlation. Correlation only will tell you in which direction you are moving, by how much you are moving. Magnitude of movement is given by regression line. Magnitude of movement. Magnitude, how much? And in mathematics, if you want to estimate something, it has to be an equation. Equation, when you represent in graph, it becomes line. That is why it's called as a regression line. Now, correlation formula, that is R, is what we write. Correlation formula is given by covariance, COV, covariance between two variables, covariance x comma y divided by standard deviation of x into standard deviation of y. How do you calculate standard deviation? I just already told you. How do you calculate variance, covariance? That is summation x minus x bar means deviation from x, y minus y bar deviation from y, and divided by n. We take an average. If probability is there, then covariance will be summation x minus x bar into y minus y bar multiplied by p, multiplied by probability. That is going to give you covariance. Covariance divided by standard deviation of x and y will give me r. If r is positive, that is they are likely to move in same direction. If r is negative, they are likely to move in opposite direction. But how much they move, that is given by regression equation, where we say y equal to a plus bx. So in the regression line, so many points if are scattered, you draw one line such a way that some points are above, some points are below. This is an average relationship. That is what is called as regression line. Is also called as method of least square, because we make sure that the difference between the line and the point, called as deviation, the square of that is minimum. That's just a mathematical part. You don't worry much. The formula is y equal to a plus bx. B is given by r into standard deviation of y by standard deviation of x, and a equals y bar minus b into x bar. And actually the a value is easy to remember. You just revise the equation. Y equal to a plus bx. You bring bx to left side. What will happen? Y minus bx. That's the formula. Y bar minus bx bar. That's the formula for regression line. And in a graph, this starting point of the line, that is called as a, and by how much it moves, one unit, that's called as b, or mathematically a is called as intercept. More importantly, b is called as slope. If slope is positive, line is upwards. If slope is negative, line is downwards. If slope is 0, line is flat. Anyway, that's regarding the mathematical part. What you should know: what is correlation, what is the formula, how do you interpret, what is regression line, how do you calculate, what is interpretation, that is it is used for estimation, for measurement of movements. That is the essential part in portfolio management. The different theories we are going to discuss now will have application of these things. That is why these things would have been there in your statistics. I'm sure many people would have ignored it or forgotten by now, or those who come from direct entry, you would not have chance to visit this. So I did a quick recap of what is essential at this level. So you don't have to go back to previous level and read these things. This much concept you know, this much formula you know, sufficient in portfolio management. Any question on this? Can I go to portfolio management? Any questions? Is it done? Okay, I believe it is done. I'll go further. Portfolio theories. Okay, first of all, you understand this portfolio management theories are evolution. That is, it is developed over a period of time. First, we had Markowitz portfolio theory. This is the first theory which talked about portfolio management. It came in 1940s. And this is the first theory which connected the two aspects. Risk and return were always calculated separately. It was mixed. It's connected in the first theory, Markowitz. I'll give the formulas one by one. And after this, we had sharp. Basically, we had capital allocation line, CAL. And this capital allocation line then became capital market line, CML. This is capital allocation line, allocation between risk and risk-free security, capital allocation line. This is capital market line, where we invest in market portfolio, capital market line. And then we had a characteristic line, characteristic line, where we talked about the market and security. And then we had security market line, that is SML, or also called as most popularly CAPM, and the latest one is arbitrage pricing theory. So let me let me tell the full form. You please make sure you write it. First one is Markowitz. Then we have CAL, capital allocation line. CML, capital market line. Then characteristic line. SML, security market line. I don't have the space. Hope you can write it. SML, security market line. Security market line. CAPM, capital asset pricing model. Most important one. SML, security market line. CAPM, capital asset pricing model. Then APT, arbitrage pricing theory. This is the evolution of portfolio theory. We also have other small aspects like international portfolio, mutual funds, or we have Sharpe ratio calculations. Those small aspects are there, but this is the broad uh, portfolio theory we have to understand. So Markowitz is the one who first talked about or established connection between risk and return. He is the one who first established risk was separate, return was separate. He connected both. Markowitz was the first person. This characteristic line, we also going to call, we are going to learn something called as Sharpe portfolio or Sharpe risk. Just remember, along with characteristic line, we are going to learn Sharpe portfolio as well. Capital allocation line means it is allocation between allocation between risk-free assets and risky asset and security also. Allocation between risk-free asset and security. Capital market line is allocation between risk-free asset and not security, between risk-free asset and market. Characteristic line, it is connection between two things. It is connection between or analysis between RS and RM. RS means return of a security and return of markets. And here we also going to learn important aspects such as beta, and beta we learn later also, or here we are going to learn two important aspects. One is systematic risk, other is unsystematic risk. And CAPM or SML, who is the first one which we connected risk and returns. But no, Markowitz also connected risk and returns. No. SML or CAPM equated the return based on risk. So they expressed risk and return within the same equation. So I don't have space, you can write down. CAPM expressed risk and return within a same equation. Expressed risk and return within a same equation. Expressed risk and return within same equation. APT, arbitrage pricing theory. Arbitrage pricing theory is an extension of CAPM. Is an extension of CAPM. I'll discuss that when we go to the formula one by one. I hope you got the overall view of portfolio theory. We'll take one by one now. First, we had Markowitz. Okay, Markowitz risk or first is return. If it is two security portfolio, return of portfolio RP, same one R1 W1 plus R2 W2 and so on. How many of our security might be there? Risk of Markowitz security, risk standard deviation of P. He is given the formula like this. You understand R1, return from security 1. R2, return from security 2. W1, weights in security 1. W2, weight in security 2 and so on. Risk of Markowitz portfolio is given like a formula A plus B whole square. You see, the formula looks like this. It's look big one, but don't worry. It's a simplified one only. W1 square sigma 1 square plus W2 square sigma, or let's say I'll do sigma 1 first. Standard deviation of first security square. Any variance, any simplification, I need variance. W1 square plus sigma 2 square W2 square plus 2 sigma 1 sigma 2 W1 W2 and multiplied by R between 1 and 2 square root. I'll just rewrite this. 2 W1 W2 sigma 1 sigma 2 multiplied by R between 1 and 2. R means correlation coefficient between 1 and 2. This is, look, remember like a plus B whole square formula. This is A square, sigma 1 square W1 square. This is B square, sigma 2 square W2 square. Then 2AB, 2 W1 W2, sigma 1 sigma 2 multiplied by R. That R is a extra factor. Otherwise, I could have simplified as A plus B whole square only. So in fact, R equal to plus 1. In that case, the formula actually becomes like A plus B whole square, and square get cancelled. It becomes A plus B. So if R equal to plus 1, formula is very simple, like a return sigma 1 W1 plus sigma 2 W2. But anyway, you apply this formula for a 2 security portfolio. For a 2 security portfolio, it is A square B square 2AB. If it is 3 security, A square B square C square 2AB 2BC 2CA. 3 security is sufficient from exam point of view. But 2 first you remember, then you think about 3. Or as I told you, it is correlation coefficient between uh, sigma 1 and sigma 2. And in fact, this sigma 1, sigma 2 and R, no, all the 3. This 3 you can also simplify by covariance. Sometimes they give covariance, directly I can do. Sigma 1, sigma 2 and R, all the 3 put together, I can call it as covariance between 1 and 2. So like this, if I calculate risk of a security, portfolio of a security, and if I represent in the graph, how does it look like? He draw the graph like this. X-axis, he say standard deviation of portfolio, and y-axis, he say return of portfolio. And what he says, if you want to reduce the portfolio, risk, the security should have negative correlation. Securities with negative correlation will reduce portfolio risk. Securities with negative correlation will reduce portfolio risk. Why is it so? Mathematically, you understand, right? If R is minus, the overall calculation will reduce. Risk will reduce. Mathematically, negative correlation security will reduce the risk. Logically, imagine you are having Infosys and you are having Indigo. One export oriented company, which is Reliance or which is Infosys, and another is import oriented company, which is Indigo. So if US dollar increase, Infosys will have higher sales, higher income because export oriented, whereas Indigo, their crude oil, that is their aviation turbine fuel, is going to cost them more. So they are moving in opposite direction. So one will increase, other will decrease. Overall, portfolio will not be affected. Otherwise, if you invest both in Infosys and TCS, if the share price, if the dollar rate increase, both will increase. If dollar rate reduce, both will reduce. You understand? If you want to have lesser portfolio movement, include the security with opposite moments. That is what is negative correlation, opposite moments. And this concept technically called as diversification. So very important technique. If you are constructing a portfolio for yourself or for somebody else, when you bring in portfolio, yes, don't put all the eggs in same basket. You have to invest in multiple securities, but invest in multiple securities that belongs to different sector. Don't select only IT companies. Don't select only petroleum companies, only FMCG companies. No, mix all of them. During Corona, banks got a hit, but pharmaceutical companies had a very good run. And when markets started recovering, pharmaceutical fell down, real estate companies increased, and in concept theory, practically we also have something called as sector rotation. Some sector will be down, some other sector will be up. Real estate to pharmaceuticals to IT companies to banking sector, all sector will not go up every time. So it is important you have a portfolio which has the essence of different sectors, different nature. So security with negative correlation will reduce the portfolio risk. That's called as diversification. And what he says, if I change the weights, standard deviation is there, return is there. If I start changing my weights, then what will happen to the risk of a portfolio? This is 0. Portfolio risk starts reducing when I change my weights up to a point, portfolio risk start reducing and risks start reducing, returns start increasing up to a point, and after which risk also starts increasing, return also starts increasing. That is, he says anything below this point, whether it takes turn, this is called as optimum points or optimum portfolio, or we'll say minimum variance portfolio. This point is called as minimum variance portfolio. And if I take a point anything below that, so please observe, if I take a point anything below that, so let's say I take point A and the point B. Now, which is superior between A and B? B is superior. Why? Because B is having higher return for same risk, right? The line is same risk, but B is higher return. If I select point C and A, C is having a higher return and lower risk. It's coming left side and on the top. So a portfolio is efficient if it is having a same risk but a higher return, or same return for a lower risk, or it is having higher return for a lower risk. And he called this, after this cutoff point, anything on this point, this line, he called it as Markowitz efficient frontier. Efficient frontier. Remember, each point on this line, the curve represents a different portfolio having the different weights. We are talking about two securities having same standard deviation, having same meaning average returns, but the weights we change. Once we change the weights, portfolio returns will change, portfolio risk will change. But there will be a point where risk will start increasing, return also starts increasing. That is called as efficient frontier, because on the efficient frontier, if you move higher risk, higher return. So if I just write it like this is, let's say, point A and point B and point C, point D, point E. So A is inferior. So anything below the curve is inferior. On point B, that is where the turn takes place. That is the minimum portfolio variance. And after that, you keep moving, higher risk, higher returns. So this is inefficient. Point A, portfolio. CDE are on the efficient frontier, higher risk, higher returns. B, minimum portfolio variance. And we have a formula for minimum portfolio variance. If I want portfolio to be lowest, minimum, then I have to invest at point B, and that formula is given by that point B. Minimum variance portfolio. If you want to have your portfolio minimum risk, then the formula weights in security 1 is given by, just give me 1 second. Okay, so we have given by sigma 2 square minus sigma 1 sigma 2 into R between 1 and 2, whole divided by sigma 1 square plus sigma 2 square plus minus 2 sigma 1 sigma 2 and multiplied by R between 1 and 2. And you know, sigma 1 sigma 2 and R can also be substituted by covariance. And W2 is remaining. W2 is, you can calculate this, or you can just do 1 minus W1. That is how you calculate the minimum portfolio variance. This is the summary of Markowitz, and this formula, the risk calculation formula, is very important. For a 2 security, it follows the structure A square B square 2AB. If it is 3 security, A square B square 2AB 2BC and 2CA, and overall square root. So Markowitz will give the graph like this. How when you change the weights, how the risk and return will change. He is the first person who connected the both risk and return in the same chart. And he says efficient frontier, a portfolio is efficient if for a same risk it is having higher return, or for same return it is having lower risk, or for a lower risk it is having higher return. Then that portfolio is efficient frontier, efficient portfolio, and on the efficient portfolio, as you go up the ladder, higher the return, higher the risk. So which portfolio is best? You can't choose. That depends on risk appetite of the investor. If the person likes risk, then he should go for the extreme end. If the person don't like risk averse investor, you should go for the minimum variance portfolio. And how do you structure minimum variance portfolio? How do you calculate the weights in minimum variance portfolio? That formula is what I just shared with you. This is Markowitz. Hope you have taken it down. Any doubts in any of these parts? Of course, when you take up problems, you'll be able to understand better. But first, you get the overview. Okay, I hope you have done. Okay, next we have improvisation of Markowitz. Now, what is the main limitation of Markowitz? It's definitely a very important model. From exam point of view also, you will have a lot of questions from this model. But what is the one small factor which is not caused in Markowitz? That is, Markowitz did not consider risk-free security. Even for zero risk, you can expect some return. That point was not discussed, explained by Markowitz, which is what explained in capital allocation line. So basically, Markowitz student Sharp has come up with capital allocation line. He also come up with many other lines where he told for this curve, he draw a tangent mathematically. There were also concept of utility curve and all that let's not forget, let's not look into it. Let's focus on overall concept. So by considering risk-free security, if I invest in both risk-free security as well as risky asset, if I mix both and I draw a tangent to the curve, that results in capital allocation line. So from now onwards, we don't talk about the curve, we will talk about the line. So here we have standard deviation of portfolio, here we have risk of portfolio, and here we represents 0, and this is risk free. So capital allocation line, you draw a individual point or draw a line such a way that each and every point represents investment in risky security and risk free security. If you invest here at this point, you're investing only in risk-free security. Let's say at this point, this is risky security, let's say RS, and here you're investing 100% in risky security X or S. And anything below that, that means you're investing in both. This is standard deviation of S. Now, capital allocation line, when everybody follows the same pattern, the security becomes market. That is important from your syllabus point of view. We have CML, that is capital market line. This chart is important for you more than CAL. So x-axis, y-axis. X-axis we have risk, y-axis we have return, and zero origin, and we draw a line. The starting point is risk-free, and let's say this one is market return. That is, if I dot this one, this is market risk. Market risk means sigma m, and this is market return. Market return, that is RM. So if I draw different portfolios, let's say portfolio on this one, that is entirely in risk-free security. The second, this is investment in risk-free security and market portfolio. And this third one, investment only in market portfolio. And fourth one is interesting, you are investing more than in market portfolio. So let me write it down. The first one, 100% investment in risk-free security, in risk-free asset. Risk-free security, government bonds, fixed deposits, treasury bills. Second portfolio is investment in risk-free security and market portfolio, combination of both, and markets portfolio. So this is risk-free actually, because you're investing everything in risk-free. This is risk-free, and this will be less riskier than market. And third portfolio is investment, 100% investment only in market portfolio. So this will be same risky as market. Same risk as market. And fourth one is very interesting one. More than 100% investment in market security. More than or greater than 100% investment in market portfolio. One thing, can you imagine? How can I invest more than what I have? I start business. I get 1 lakh. Can I invest more than 1 lakh in my business? Is it possible for me to invest more than what I have? Yes. How? By borrowing. So more than 100% investment in market portfolio by borrowing in risk-free security, risk-free asset, risk-free security. You're going to borrow and invest. And therefore it is more risky than market. So if I have 1 lakh, I invest in Infosys share. Whatever Infosys movement, that will be my portfolio movement. But if I borrow and invest, then my return can be more than what Infosys gives me, or my return can be lesser than what Infosys can give me. It is more risky than market. So basically, this fourth one is leverage position, borrowing. Leverage position, borrow and invest. So one is absolute risk free, second point is less risky than market, third point is same risky as market, the fourth point is borrow and invest, so more risky than market. And formula is also given by CML. Return of the portfolio is given by risk-free security plus RM minus RF multiplied by sigma P, that is portfolio risk, divided by sigma M. So basically it tells you market risk is so much. How much risk you can take it? You want to take more than market risk, or you want to take same as market risk, or you want to take less risk than market risk. Accordingly, the weights will be decided. So this is the formula where you compare the risk and return within the same formula that is given by CML capital market line. So this is the desired portfolio risk. Desired portfolio risk. How much risk you would like to take? If you take so much of risk, you should expect so much of return. This is the expected return for given level of risk. Expected return for given level of risk. Okay, so this is capital allocation line and capital market line. Then we go to the most important one, that is security market line or CAPM. But before that, one more very important one which bridges the gap, that is called as characteristic line. Characteristic line. And basically, so far we talked about risk and return, right? Risk of a portfolio, return of a portfolio. Now, characteristic line is one which does not talk about risk and return. It talks about return and return. Means on x-axis, it will talk about uh, market return, and y-axis, it talks about security return. What is the connection between market return and security return? To what extent security is dependent on market? And we are going to draw a line. This is nothing but regression line. Remember, we discussed regression, relationship, regression equation. So regression line between market return and security return. Market return and security return, that is given by return of security is dependent on return of market. So return of security is A plus B or beta into return of market. So the starting point is called as A, or some people say alpha, and by how much 1 unit of market will give you 1 unit of RS, that is going to give you beta. And this is regression line. So actual points, if I put it, some points may be above, some points may be below. And when you calculate an average relationship such a way that some points above, some points below, and you draw a line through that, method of least square, and that is what is regression line. And regression line in statistics, but characteristic line in portfolio management. Formulas are same. Beta is given by R into standard deviation of security by standard deviation of markets. And R formula you already know. Let me write it anyway. R is covariance between security and markets divided by standard deviation of security, standard deviation of market. And covariance formula you would know. I'll repeat once more. Covariance is between summation S minus S bar into M minus M bar whole divided by N. And what is the formula for A? Simplify the original equation, which is Rs bar minus beta into Rm bar. We should discuss little bit more about beta. We should discuss about application of beta, and we have systematic risk, unsystematic risk, things like that. And then we go to SML, security market line. But they can ask you in the exam only about build a characteristic line. This is the set of formulas you have to remember. Okay, I hope you got it. Any doubts in this calculation, in this set of formulas? Of course, when you take up the problem only, these formulas, you can remember it better. But this is the summary part. Hope everything you're trying to bring it in the same place. And these things what you're writing now should act as a summary for day before exam as well. So everything I'm trying to give in one place. Okay, so let's do one thing. Let's take a break now because quite a few more things are there. We have beta calculation, systematic risk, unsystematic risk, security market line, CAPM, arbitrage pricing theory. So quite and sharp portfolio. So quite a few things are there. So we'll take a small break now. 7:30 now. Take a break of 10 minutes and then we'll go further. Take a break of 10 minutes. Okay, so let's move on. So we just discussed about characteristic line, and one of the important aspect is beta. So let me talk about beta formula, quite a few varieties. But before that, let's understand interpretation of beta, which is a very important aspect practically as well as from exam point of view. So what is the beta? Beta, I would say, it is a measure of sensitivity. Between what? It's a measure of sensitivity between market movement, or between security movement and market movement. Or basic formula we also say like this: beta equals change in market, or change in security return, change in security return divided by change in market return. Percentage change. Okay. Percentage change in security return by percentage change in market returns. So if beta equals to, let's say, 1.2, what does it mean? Beta equals to 1.2 means if market moves by 1%, the security will move by 1.2%. So we are trying to understand the sensitivity movement of a security with response to markets, reaction to the market. So what is sensitivity? To tell you a quick example, how was your life when you were in first year of articleship? How was your life when you were in last year of articleship? First year of articleship, for small things also, you used to get scolding from your boss. You used to feel like crying, and you would have cried as well, and you will be like, what mistake I've done? Papa me, what mistake I've done? And in final year of articleship, if your boss is scolding you, you don't feel any bad. You are used to it. If he does not scold, you'll be thinking, what happened today? And if he keeps scolding, you'll be like, Papa is scolding me. Something would have happened to him. Right? Your responsiveness changed. In market also, there are some companies which react too fast. One day it is up by 3%, next day it is down by 4%. IRCTC. Look at the movement of IRCTC. Stock market Nifty would have moved by 1%, IRCTC up 10%. Stock in this Indian stock market or in Nifty down by 1%, IRCTC down by 5%, down by 6%. Where the fluctuation is high, that is measured in beta. And some stock like ITC, they hardly move. And in stock market world, we have a name for ITC. We say ITC is a immovable property. It does not change. Even if the market goes up by 2%, stock market moves, ITC move by 0.2%. Stock is down, stock market Nifty down by 2%, ITC down by 1%. Movement is small, that is low beta stocks, low risk. Movement is big, high beta stocks, high risk. So beta, we can interpret in different ways like this. Beta can be more than 0, or let's say more than 1. Beta can be equal to 1, or beta can be less than 1. If beta is more than 1, that means security return, the movement is faster than market, or you can say security is riskier than market. Security is riskier than market. Beta equals to means security risk same as market. Risk same as market, whereas a beta less than 1 means risk is security is less riskier than market because movement is small, no? So security is less riskier than market. Similarly, we can also interpret beta as beta more than 0, beta equal to 0, or beta less than 0 means positive, 0, or negative. So beta positive means market and security are moving in the same direction, which mostly the case. If stock market goes up, individual stocks also will go up. Beta negative means opposite direction, very less likely in practical life. In examinations, very much likely. Opposite direction. Opposite direction. Between what? Between security and market. What is beta equal to 0 means? Beta equal to 0 means no movement. Now, which one will not move? Whether market return increase or market return decrease, and that is called as risk-free security. So, beta of a risk-free security will be 0 because when the market return increase or decrease, risk-free security does not change. That's why it's called as risk-free. So, this is risk-free security. And what is beta of market? What is risk of market? That is beta equals to 1. Beta of markets equal to 1. This is beta of risk-free security equal to 0. Why beta of market equal to 1? Because all these calculations are in comparison with market. If market changes by 1%, how much security will change? Everything is compared with the market. So base is 1. As compared to 1, how much you are changing. It's a relative measure, comparisonal measure. Okay, we have to have some more uh, formulas relating to the beta, but if you have any doubt at this stage, please get it clarified. Beta is a very important measure from exam point of view. I'm going to discuss something called as levered beta, unlevered beta as well, little bit later. If I forget, please remind me. But I will talk about it little bit later. Any questions on this? Are you done? Okay. Let me give some more formulas of beta because beta can be calculated in so many ways, so many formulas. So let me give you a few. Beta, one basic formula, R into standard deviation of S by standard deviation of M. One thing you remember, market always comes in denominator. That's an easy formula to remember. One more formula, all formula give same answer. Covariance between security and market divided by market variance. See, rhyming words. Covariance by market variance. And covariance formula, hope you know. I'll not repeat it. We have done earlier. Or you can also calculate covariance, that is summation S minus S bar into M minus M bar. Divide by and I'll cancel. And I'll write summation M minus M bar whole square. You can also do summation Sm minus summation S into summation M whole divided by N into summation M square minus summation m whole square. Okay. Sorry, one thing I forgot here. The formula, it is n into summation sm. That n I forgot. N into summation sm minus summation s summation m, n into summation m square minus summation m the whole square. We have one more formula that's also we can use, equals summation sm minus summation s bar summation m bar whole divided by summation m square minus n into summation m bar whole square. Again, the reason why I'm giving you so many different formulas, because in different textbooks, institute only in different problems might have used different formulas. That's why I'm trying to give all formulas in one place so that you should not get confused, and all the formulas will lead to ultimately same answer. Hope you have taken down the calculation of beta and more importantly the interpretation of beta. Okay, then we will have something called as risk analysis or types of risk. That's one more type of question they can ask in exam relevant for this one. Risk analysis, or you can say types of risk. Risk analysis of security. For what reasons the share price will change? For mainly two reasons. One is systematic risk. Other is unsystematic risk. In simple words, systematic risk means macro factors. Unsystematic risk means micro factors. Means what? When a news comes, the stock price will fall. For example, Corona news. Stock market fell, Infos also fell, TCS also fell, Yes Bank also fell. That is systematic risk. If there is a general news, if the economy is affected, you are also affected, systematic risk. What is unsystematic risk? Entire economy is not affected, only your stock is affected. Yes Bank news, only Yes Bank is affected. Maggie unfit for consumption, only Nestle is affected. Indus India Bank, without any approval, they have given the loan to various people automatically. Some technical glitch, Indus India Bank will fall down. Macro factors. This is micro factors specific to company. Tata Power or Tata Motors have got an investment from venture capitalists for $1 billion for promoting, for manufacturing electric vehicles. Tata Motor stock will zoom by 10%. Micro factors. Specific with respect to company stock. This Reliance Aramco deal gets killed. The Dubai-based company Reliance and the Dubai-based company Aramco and Reliance deal get cancelled. Reliance share price fall. Micro factors. Entire market will not fall down. Hope you understood. So macro factors like inflation, GDP, economy level, political system, BJP wins or Congress wins, and stock market react to that. Macro factors. Micro factors: management of a company, profitability of a company, employees related information, labor strike, company's ratio analysis, leverage level of a company. Micro factors. How do you measure our macro factors? We can say they move in line with or in tandem with market. Micro factors move for specific reasons. For reasons specific to company or maybe sector. So this systematic risk, this cannot be avoided. This cannot be avoided. This will always be there. This is market risk. You can't take out the market risk. Unsystematic risk can be avoided. How? By diversification. Can be avoided or can be managed, I will say. I will say can be avoided, I will say can be managed by diversification. So if you are investing in multiple stocks, even if one stock gets affected, you're not really bothered. But when the systematic risk hits, every stock in your portfolio gets hit. That you can't avoid. But what is the advantage of systematic risk? When corona news comes, all the stock market falls, your stock also will fall. And when market recovers, your stock also will recover. Systematic risk will make the stock fall, will recover as well. It will move in line with the market. So how do we calculate? Measurement we have to do. First of all, how do you calculate the total risk? Total risk of a security is standard deviation of security. But I'm simplifying here, I'm analyzing here. So from the standard deviation, I'll convert it to variance. Standard deviation of security, standard deviation square, variance. The total risk of a security is sigma s square. This I will divide this into two parts. That is systematic risk. Formula is given by market return, market variance multiplied by beta of security square. And then systematic risk is residual variance, balancing figure. It's called as residual variance. Basically, balancing figure. That is sigma s square. This is total risk what you calculated minus systematic risk. Sigma m square multiplied by beta s square. And we have one more formula also. We use something called as coefficient of determination. That's called as r square. So sigma s square multiplied by r square. It's called as coefficient determination. And unsystematic risk is sigma s square into 1 minus r square. So when you invest in a portfolio, when you invest in a stock, you should make sure its unsystematic risk is as less as possible. Systematic risk you can't avoid because that is in line with market. And one more shortcut you can remember, or one more thumb rule you can remember. That is, when you move from market to security, you're moving from market to security. You treat security like your home. You're moving from market to security. The connecting point is beta estimation. This is thumb rule you can remember. I have market risk sigma m square. I want to come to my home, my security. I multiplied by beta square because market variance square, so it's beta square. So when they give you standard deviation, you should square it. If they give you variance, don't square it because variance is already squared. One more point I forgot to tell, I can apply here as well. Beta, as you can see in the formulas, these are all based on historical returns. So beta is a statistical average. It is not a proof that future will happen like this. In the past, the security moved like this. So in the future, it is likely to move by so much percentage. So all these having a basic assumption. Yes, we don't have a better method, right? Nobody knows the future. Only your astrologer will know the future. And showing astrology, you get married. So God only will help your position. Anyway, so this beta is a measure of historical data which representing what cap happen in future. All these analyses are basic assumption that only it happened in the past, it is likely to happen in the future. So systematic risk is calculated by market variance into beta of S whole square. Unsystematic risk is calculated as a balancing figure, residual figure. Any question on this? Because now I'm going to calculate one more risk called as Sharpe risk or portfolio risk using Sharpe method, where he will tell slightly different way of calculating the portfolio risk. Okay. There is one more formula we just have to confirm it here. In some problem it is there. You calculate covariance by connecting the markets. See, you have markets and market variance is calculated by sigma m square. Then you have security. Let's say security 1, and then we have security 2. Security 1, risk is measured by beta of 1, and security 2 is measured by beta of 2. So how do you connect the security 1 and security 2? Covariance. Formula you know, like x minus x bar into y minus y bar by n. That if your data is available. If data is not available, covariance between first and second security, we also calculate using this market variance and we connect with the help of beta. Beta 1 into beta 2. This also might be required in some problem where they'll give you beta of 2 companies market variance and you have to calculate covariance, you can use this. Okay. Then next we have portfolio risk using Sharpe index. Okay. Now regular portfolio risk, if they just ask, we'll apply Markowitz, A plus B whole square, that formula. But sometimes they'll specifically ask portfolio risk using Sharpe index. In that case, we have to follow this calculation. Though conceptually they look alike, but mathematically they will give you a different answer. So we are going to divide portfolio risk, that is standard deviation of P, using Sharpe index. We will divide this into two parts: systematic risk of portfolio and unsystematic risk of portfolio. So how it is going to be there? First of all, for individual security, just like I explained earlier, like individual security I have, right? I prepare this chart. For security X, systematic and systematic. For security Y, systematic and systematic. Two securities are there, let's say. Then I would like to combine both and calculate portfolio risk. So what will I do? Same structure I will do. What is that? From the market variance, from the market to come to security, I multiplied by beta. Similarly, here I have to come to portfolio. So it is going to be market variance multiplied by beta of not security, beta of portfolio square. And how do you calculate portfolio beta? Weighted average. So portfolio beta is given by W1 beta 1 plus W2 beta 2 and so on. How many hour security it might be there. This will give you systematic risk of portfolio. Unsystematic risk, how do you calculate? Not balancing figure. I don't know the total risk of portfolio. I have to calculate, not balancing figure. But from the security, I have got balancing figure in the previous chart. So I will take security 1, unsystematic risk. I will say E1, unsystematic risk of first security, square of course. Similarly, unsystematic risk of second security, E standard deviation of E2, unsystematic risk of second security, square. And I'm going to do a weighted average. Means what? I'll multiply it by W1 square and multiply it by W2 square and so on. Or instead of 1 and 2, let me call X and Y, more comfortable. So let me say this is X and Y, WX, beta X, WY, beta Y. Unsystematic risk of portfolio means first unsystematic risk of security X I'll take, that is EX square of course variance, and its weight average WX square. Then unsystematic risk of security Y, that is sigma EY square multiplied by its weight square WY square plus dot dot dot. This is unsystematic risk of portfolio, and I add both. I get total risk. Of course, variance I get. Then if I take a standard deviation, this is going to be variance. This is sigma p square equals. This is variance. And if I take a square root, I'll get the standard deviation. This, if they ask you portfolio risk using Sharpe index, you have to follow these steps. Okay. So we have done Markowitz, we have done CAL, CML, characteristic line, and portfolio risk using sharp index, systematic risk, and even about beta. And now comes the most important formula from exam point of view as well as practical application point of view, and that is security market line, or also called as CAPM, capital assets pricing model, CAPM. Okay, so let me give the formula, then graphical presentation and its interpretation. The formula given by return of security, this is expected return or required return for given risk, for given level of risk. Return of security is given by RF, risk free rates, plus RM minus RF. RM means market return minus risk free rate multiplied by beta of security. If you want for portfolio, risk of portfolio, that is risk free securities plus RM minus RF multiplied by beta of portfolio. Sir, how do you get risk free returns? Treasury bonds, fixed deposits, treasury bonds, government bonds, treasury bills. Sir, how do you get market return, RM? Index returns, I told you in the basics. Index returns, right? The benchmark returns, index return, Nifty, Sensex, their returns in the past. That is market return. How do you calculate beta? Beta is what I just told you. Calculated by security return and market return, R into sigma S by sigma M, or covariance by market variance. So many formulas I have discussed with you. And what is the interpretation of this then? And what is beta? Effectively, you understand beta represent only systematic risk, correct? So, what this theory says is, in general, if you want to understand how much return you are supposed to get from a stock, you have to understand its risk level, correct? You are investing in fixed deposit. You are investing in shares. Can you expect same return from both? I'm investing in FD for 1 year. I'm investing in equity share for 1 year. I can't expect same return because shares are more riskier. It should give me at least FD return for me. That's what I'm trying to analyze in this formula as well. That is, this is what, like risk-free return. Without any risk, I need to get this return. Or I can say this is like return for time factor. But when I invest in shares, I take more risk, so I should get more return. So this portion is, I will say, risk premium. That is return for risk premium. But when you invest in stock market, when I invest in shares, when I start a business, every business may not be same risky. Software and consumer goods, software and let's say manufacturing companies, real estate companies are more riskier than, right? So each sector is more risky and each company is more risky. We want to differentiate them. That is what is represented by beta, risk of a particular security. But we don't want to go for standard deviation method because in general in the market, when the number of variables increase, this like in a family, if you become joint family more and more, if number of people increases, individual feeling does not matter more than specific factors. It always the macro factors which is dominant. So we will not take total risk into consideration. We will take systematic risk into consideration. So what is the excess return with respect to the systematic risk? That is what is multiplied by beta. So Rn minus Rf is called as market premium. Rn minus Rf is called as market premium over and above risk-free rate to be given by market, and RM minus RF into beta or risk of security minus risk-free rate over and above risk-free rate, how much you are giving, that is called as security risk premium. Security risk premium. Let me give a numerical example for you. Suppose risk-free rate is 10%, market return is 12%. What do you understand by this? I'm investing in risk-free return. I'm investing in FD, treasury bonds. I get 10%. I invest in stock market. I get 12%. I'm expecting more in stock market, from the Nifty, from the Sensex, from the benchmark. Why? Because I'm taking more return, more risk. I'm expecting 2% extra return. But if beta equals to, let's say, 1.5, what is beta equal to 1.5 means? If security moves by 1%, if market moves by 1%, then security will move by 1.5%. How much return the market is giving for taking risk? How much is market premium? 2%. Market is giving 2% for the market movement. I am taking 1.5 times risk of market. I am taking more risk than market. So I need more return than market. So if market gives me 2%, my security should be 1.5 times of it. So 1.5 times of 2, I need to get a risk premium of 3%. So 10% risk free plus the risk premium. Ultimately, my security should give me 13% return for taking so much of risk. That's what RF10, RM minus RF 12 minus 10 into beta into 1.5. So because I take more risk than market, I need to get more risk premium than market. That is what is justified by RM minus RP. And remember, this is just a required rate, or you can also say expected rate. Actual rate is different. And based on the actual rate, you make a decision. We'll come to that. First, you write down this much CAPM, and in the formula or in the explanation, if you have any questions, get it clarified. Then I'll write the chart, and then we'll tell you how to make use of this in application problems. Okay, now let us go further. Hope you have taken it down. Representation of CAPM on graph is called as, or results in, SML, security market line. Security market line. So if I draw a graph, this is risk, and to be specific, I represent as beta. That is, I am measuring systematic risk. In capital market line, standard deviation, total risk. But security market line, SML, is beta, systematic risk. And this is of course return. And I draw a graph. This is 0. Starting point is RF. And I'll select, let's say, a market risk, means beta equals to 1. and here this is market return, that is Rm. Market risk means beta equal to 1, market return Rm. And if I select something here, that is beta equals to, let's say, 0.5, means less risky than market, and return of that security, let's say R1, return of security 1, beta 1, let's say. Similarly, if I take something here, beta more than 1, more risky than market, let's say beta equals to 1.5, that is, let's say this is equal to R2. So if you take same risk as market, you will have same return than market. If you take more risk, you will get more returns. And this is expected return or required return. Okay, this is what is CAPM. This line represents CAPM, required return, or you can remember cost of equity. This formula what we calculate, RF plus RM minus RF into beta is cost of equity. In our DCF calculation model, FCFF calculation model, various places we have to do discounting, right? Remember valuation of equity share? In FCFF model, we need cost of equity. We calculate the cost of equity using CAPM model. Till today, practically, also we use CAPM method for its simplicity as well as for its effectiveness. Effectiveness because it explains systematic risk. Simplicity because you can calculate for any stock, share price is required, market price, that is the index return is required. Using those two, you can compute easily the beta and RM and RF. So data is available in practical life easily, therefore CAPM is widely used. CAPM is like cost of equity. Okay, then application problems. Based on this, should you purchase the shares or sell the shares or hold the shares? So you can have three kinds of recommendation: buy, sell or hold. When do you buy the share? Of course, when it is underpriced in the market, in the sense, as per CAPM, it is supposed to give you 12%. Based on its risk level, it is supposed to give you 12% return, but you look at the historical average, it has given you 13%. It has given more than what it was supposed to generate. Then we say buy, that is the return, or whatever you say, average return or portfolio returns. We just say average return is greater than CAPM return, is greater than cost of equity, that is CAPM return. When do you sell it? You sell when the return is not given you so much return. The average return in the past or actual return in the past is lesser than the cost of equity, is lesser than what you expect. How do you calculate the expectation? With the help of CAPM. And if it is equal, average return is equal to cost of equity, then we say hold. Buy means it is underpriced in the market, undervalued in the market. This is undervalued, or you can say underpriced. So we buy. This is overvalued. So we sell. And it is equal. So we just say it is correctly valued. If it is undervalued, then we are going to buy. If it is overvalued, we are going to sell. If it is correctly valued, then we are going to hold. And in fact, if you represent in graph, what is undervalued comes above the line. The cost of equity line is this. And if this line, if suppose this point comes here, actual return or average return comes here more than what you expect, this is what is called as buy, or is a undervalued. This will be buy. If average return is more than expected return. And in fact, this difference is called as alpha. To be specific, we are going to learn one thing called as Jensen's alpha. Means it is giving more return than what is expected. And if it is below, then negative return, it is giving below what is expected. And how do you calculate the average return? This average return sometimes will be historical average, sometimes it can be actual, and sometimes it can be dividend yield also. That will be taking it as a proxy for average return because nobody knows the future. So this can be average, or this can be actual, or this can be sometimes dividend yield of the stock which has been received in the past. So the most application important problem concept from practical point of view as well as from exam point of view is CAPM or SML. They can ask you theory or they can ask you problem based on this. Okay, I should talk about the types of beta, levered beta, unlevered beta. I'll talk about little bit later. First of all, I'll go to one more theory, that is next theory called as APT, Arbitrage Pricing Theory. Arbitrage Pricing Theory, APT model. This is an extension of CAPM model. What we told regarding CAPM model, RF plus RM minus RF into beta. What is beta? Systematic risk. APT theorem is one step further. What these people tell, don't take one beta, take different beta. Why? Because every factor will influence the companies differently. For example, interest rates will affect banking industry more rather than software industry. US dollar rate will influence more software industry than banking industry, right? Petroleum price will influence aviation industry more rather than consumer goods industry. So different sectors will be influenced differently for factors. So don't take one beta for one factor, take one beta. Which factor to consider? Whichever factor you like. The formula will not tell you. Your company is influenced by interest rates, inflation rates, USD rates. Okay, for your company, you take three factors. Oh, other company, you're influenced by interest rates, inflation rate, manufacturing data, service data, GDP data, and also the real estate companies, the real estate movement. Your cement manufacturing company, so real estate growth is required. That is also a factor applicable for your company. You take five factors. So arbitrage pricing theory, the cost of equity, expected return is given by starting point is same only. They say lambda 0, nothing but risk-free rate. But what you increase, RM minus RF, premium, right? They call lambda 1 multiplied by beta 1. RM minus RF into beta. That was CAPM. Then extend further. They are not only telling for one factor, take many factors, lambda 2, beta 2, plus dot, 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 dot. Beta 1, beta 2, you understand? This is factor risk. And lambda 1, beta 2 and all is called as factor risk premiums. Factor risk premium. Now, beta, how do we calculate? Based on market price and security price. I mean, market return and security return. But factor risk premium, how do we calculate? It's not so easy to calculate practically. So, in one place, this is mostly used, that is in exams. So they will give you factor risk beta, they will give you factor risk premium, you just have to compute. So this is very ideal method, not realistic method. So till today, this is very good theory, theoretically, but practically we still use CAPM. Because practically it's not so easy to get data out. Which factor is applicable to you? How do you calculate that factor? How much impact on your share price? Difficult to ascertain. But in exam it's easy because they will give you the data in the question itself. That is arbitrage pricing theory. Okay. Miscellaneous concepts now. One of them is types of beta. We have something called as levered beta, unlevered beta, and proxy beta. Let me talk about it briefly. You imagine a company. You imagine a company who has equity as a source of finance, also who has debt as a source of finance. And they will invest in various projects. They'll invest in various projects. Okay, now when economy changes, when the economy changes, sales are growing or corona news, government comes up with some new projects or some news, your returns also will change. So your project profitability is affected by market factors, economic factors. This is called as asset beta, or also called as unlevered beta. Or in your IPCC terms, this is called as operational risk. Remember, three types of risk was there: operating risk, financial risk, combined risk, right? So this asset beta or unlevered beta, this represents operating risk of a company. Now, if company takes more debt, then you will be having more riskier. Then what is the reason? Beta of debt, let me call it as B of D, will usually be 0. Why usually be 0? If the project is performing or not performing, beta, I mean debt people, not dead people, debt people, loan, they are not bothered. They want fixed rate of interest. So whether your project is performing or not performing, usually beta of debt will be 0. Usually it will be 0. So that risk is also now have to be borne by equity people, that we called as levered beta. Levered beta, or this represents financial risk and operating risk, because if the project is not performing well, that loss you have to take care. And what was supposed to be shared by the debt, they're also investor, their risk is also on you, your obligation to pay interest. That's what is called as equity beta, or also called as levered beta. Some people think equity beta means unlevered. Equity means only equity, no debt. No, don't think like that. Common mistake. Equity beta means after considering the impact of debt. These are different terminologies. So how do you calculate? What is the mathematical derivations? Let me tell you quickly. Sometimes a beta of debt may not be 0 also, my dear friends. Even debt people, lenders will carry some risk. SBI has given loan to Kingfisher. Now they are suffering, right? So even there will be some risk in case of debt also. So in some problems, they might give you beta of debt is 0.2 something. They might give like this. So debt also carry some sort of risk, credit worthiness, credit risk. But if nothing is specified in the exam, we will take beta of debt as 0. So if I do a simple weighted average, what is that? Equity beta, levered beta. How much we invest in the equity? Equity by equity plus debt. levered beta into its weight plus unlevered beta, beta of debt into its weight, debt by debt plus equity, that is equal to unlevered beta, project beta, asset beta. If beta of debt equal to 0, then it will be simplified. I don't want to show the derivations, you can do mathematically, but why this line I've shown you, because if they've given you debt beta something equal, then you have to make use of this formula. Only when beta of debt is 0, then we can use this simplified formula. If beta of debt is 0, then this simplified formula only I'm telling you. Levered beta is given by unlevered beta plus, or if I say 1 plus debt by equity. And for after tax purpose, I multiplied by 1 minus t. And unlevered beta is a simplification, levered beta divided by. So unlevered beta represents operating risk, levered beta or equity beta represents levered risk, operating risk as well as financial risk. So equity beta represents combined risk. If their debt beta is 0, you can use this formula directly. If debt beta is not 0, then you have to use this equation. Of course, wherever debt is there, you make it as into 1 minus t. This is the levered beta and unlevered beta. Okay. Next, one more very important aspect is there, that is proxy beta. I will go to this, but make sure you write down these things, and if you have any doubts, please get it clarified. So this is financial risk and operating risk, combined risk. Okay. Now, when we want to value private companies, unlisted companies, we follow free cash flow method. Free cash flow we can calculate, but we need discounting rate. Discounting rate means we need cost of equity. Cost of equity means we require CAPM. For unlisted companies, how can you apply beta? How can you apply CAPM? Because you need share price, right? Market return, security return, RM, RS. Only if that is there, I can calculate beta. For unlisted companies, we will not have that luxury of calculating beta. In that case, what do? We follow this proxy beta, used specifically in unlisted company valuation, used in valuation of unlisted companies who don't have share price. For example, if you're valuing a software company, I would like to calculate the software company, but that company is not listed. Then what do? Okay, take the beta of any software company, let's say Infosys. But one problem is there. Why? Because their capital structure may be different from my capital structure. They have taken more loan, I might have taken less loan, or vice versa. So what we should do? From their levered beta, we should eliminate the financial risk. We should eliminate the debt equity element. So in that case, it represents pure operating risk, unlevered beta. Then for that, you apply your company's financial risk, your company debt equity ratio, then you get beta levered relevant for your company. And one more thing also will be there. How can you take only one company into consideration? There will be many software companies, then you can take an average. Okay, so let me tell you the process. If only one company is there, good. But many proxy company will be there, many companies in the same sector, or we call it as pure play firms, companies into same sectors. So we will have pure play firms. means companies into single sector. If it is multiple sector, that again will be diluted. Pure play firms, companies into one sector, single sector. So you will have, like for example, company A, company B, company C, company D. Example I'm giving. Let's say 4 companies are there. So you will have levered beta for all those companies separately, right? Levered beta. Now from their levered beta, I would like to compute unlevered beta by applying the debt equity ratio of respective companies, debt equity ratio of A, debt equity ratio of B, debt equity ratio of C, like that. So we get unlevered beta of different companies after taking their debt equity ratio out. Then what I do, now all these things represents only operating risk, I will take an average. That average unlevered beta represents purely operating risk. And once you take an average, then you can apply the debt equity ratio of the private companies or company under valuation, debt equity ratio of the private company or unlisted company, which is the financing risk. Then you get, once you apply this formula, you get levered beta, which represents combined risk. And using levered beta, you can calculate CAPM, means you can calculate cost of equity, and using cost of equity, using valuation, that is FCFF method, you can compute the value of company, present value of company. And how do you calculate unlevered beta? The formula I just gave you. We assume that debt beta of 0. And how do you calculate levered beta? The same formula I've given. 1 plus debt by equity into 1 minus T. That is the levered beta. Unlevered beta is levered beta divided by 1 plus debt by equity into 1 minus T. Formula I just gave you. So the starting point will be levered. From that we make it as unlevered. And from that we make it as levered. This is the process. LUL, LUL, whatever, Lulu market, whatever you want to remember. We start from levered, we take out their financial risk, we take out their debt equity, we get unlevered, then we apply our debt equity, we get levered, applicable for our companies. This is the use of proxy beta applied in valuation of unlisted company or private company. Okay, hope this is done. Next we have some ratios for evaluation of portfolios. Ratios for evaluation of portfolios. As an individual, can I buy portfolio? I can buy shares. Can I buy portfolio? Yes. How? Through mutual funds. So I will say it's evaluation of portfolio or evaluation of mutual funds. Evaluation of mutual funds. Actually, this topic comes more in mutual funds in your study material and all. But I wanted to connect this portfolio only because after all, mutual fund is a portfolio. So I've included here itself, in this chapter itself. There are 3 types of portfolios or 3 types of ratios. One is Sharpe ratio, other is Trainer ratio, then we have Jensen's alpha. And in the exam, they can ask you to calculate and ask you to rank. They'll give you 5 mutual funds. They'll ask you to calculate these ratios and ask you to do a ranking. A typical question asked in exams. Sharpe ratio given by return of portfolio RP minus risk-free rate RF divided by standard deviation of portfolio or standard deviation of security. Trainer ratio is RP minus RF divided by beta of portfolio. Jensen's alpha is whatever is the actual return or average return minus CAPM return. You remember in the graph, CAPM graph, I told you what comes above the line, that excess is called as alpha. That alpha is Jensen's alpha in the CAPM return over and above the line. Line represents CAPM return. Above the line, if you're expecting, if your average return is above the line, so you're getting more return than expected, that is called as Jensen's alpha. So this is excess returns. This represents excess returns over expectation, over expected return, over expectation. Whereas Sharpe ratio, trainer ratio, what they represent? RP minus RF, what do you call? Over and above risk-free rate, that's called as risk premium. So this is Sharpe ratio represents risk premium or return for 1 unit of, this is standard deviation. Standard deviation means total risk for 1 unit of total risk. What does trainer ratio do? They also do the same thing, but denominator is not total risk, denominator is not standard deviation, denominator is beta. So they tell you it is risk premium for 1 unit of systematic risk. So one person uses risk premium for 1 unit of total risk, other person uses for 1 unit of systematic risk. And all the ratios, higher the better. So if they ask you to rank individually, of course, separate ratios separately, whichever ratio comes highest, whichever stock, whichever security, whichever mutual fund has got the highest ratio, that will get the first rank. All the ratios, higher the better. And easy to remember, Sharpe ratio, S for Sharpe, S for standard deviation. Another one, trainer ratio, beta, in beta, T is there, beta, so T for beta. Remember one thing, other is like a balancing figure. S for Sharpe ratio, S for standard deviation. And another one, trainer ratio, considers beta, systematic risk, Jensen's alpha, over and above CAPM returns. You will find more of these questions in mutual funds, maybe in study material, but I have included it in portfolio topic itself. Any questions on these ratios for evaluation of portfolios or mutual funds? Okay. One more small topic, or let's say two more small topic, so that the discussion on the summary part will be completed. So when you do the problem, you can connect these points easily. One we have is portfolio rebalancing. Portfolio rebalancing. What do you mean by portfolio rebalancing? We invest in a portfolio with a certain objective. For example, I'm investing in equity, I'm investing in debt. I want to invest 50-50. So I have 1 lakh with me. So today I invest 50,000 in equity. I invested 50,000 in debt or risk free, let's say. Now, after 1 year, stock 50,000 has grown by 10%. Means 50,000 became 55,000. Let's say debt has not grown. For simplicity's sake, let's say it remained as 50,000. Now I want to rebalance. What do you mean by rebalancing? I want to realign. I want to have same equal ratio now. So because of the mark, I'll invest in certain proportion. Now when the market price changes over a period of time, the weights will change. But I want to realign. I want to make it equal. Example I'm giving. Practically, you can have many other objective. I'll invest 40% in software, 30% in consumer goods, 20% in FM, let's say pharmaceuticals, 10% in real estate. After 1 year, the value would have changed. I need not wait for 1 year. I can do 6 months once, 3 months once. In fact, Nifty. What is Nifty? Top 50 companies in NSE. Many other factors are there, but major factor is top 50 company by market cap. But every day top 50 can change, right? Do you think Nifty will change the portfolio every day? No. They say we will rebalance it every 6 months once. Every 6 months once we rebalance it. So every 6 months we look at what is top 50 companies. So there might be one new company entering to the 50 or one or two companies might be exiting out of top 50 companies. So periodical review should be done. Realignment with the objective, that's called as portfolio rebalancing. Now in this simple example, if I want to make it equal, what should I do? 55,050. I want to make it equal. Take 5,000 and put it here. But that becomes 50, this becomes 55. So what do? You write the total 1,05,000. Write the total. Then you divide. What is the target investment? This 1,05,000 should be in the equal proportion. So 1,05,000 divided by 2, this is 52,500. This is 52,500, which means debt you need to buy 2,500 and equity you need to sell 2,500. And now you will have equal weights at this point in time. Again, after 1 year or 6 months or 3 months later, the weight changes. You will realign by selling in one, by buying in one, aligning with the objective. So what is the process? We'll have initial portfolio, and after 1 year, the actual portfolio, then we will revise it. Target portfolio, the actual portfolio, target portfolio, the difference represents what to buy and what to sell. That is regarding portfolio rebalancing. You can take this one simple example, theory not required. Okay, so I hope you are able to understand this portfolio rebalancing. One last topic is there, that is international portfolio. So you're investing outside India. So when you invest outside India, you get two types of returns actually. You invest in bonds. Let's say you invest in bonds. The bond return you get, but the bond return, suppose you invested $100, now you get, let's say, $100. Still you have profit. Why? Because conversion rate was 60 rupees earlier, now it may be 70 rupees. So for Indian investor, investing, let's say in US. For Indian investor investing in US, the returns is going to be calculated as, we'll have two types of returns. One is returns in dollar terms, that is whatever the dollar return for a US investor, returns in dollar term, that is basically return for a US investor. And you also get return in the form of currency appreciation. Currency appreciation. That is, if dollar appreciates by 1%, that also you get. Bond returns give you 5% and currency appreciated, dollar appreciated by 1%. So 5 plus 1, 6% you get. If it currency depreciate, of course, you will lose. But we don't do plus. We always do multiplicative model. So 1 plus return for Indian return, whatever, return for Indian investor equals 1 plus dollar returns into, again, we don't do plus, okay, multiplicative model, 1 plus currency appreciation, dollar appreciation. Or if it's depreciation, it will be minus. So 1 plus return for Indian investor is 1 plus dollar returns into 1 plus dollar appreciation. That will be the return for international investment. Okay. So this is the complete overview of portfolio management, including the logic, all the formulas, all the theories, all the charts. I hope you got a overview of the chapter, and when you do the problems, please try to connect these topics. If you have any doubts, I'll clarify. Otherwise, we can conclude. Examination point of view, this chapter you can expect sometimes in the exam for 15 marks, 20 marks also, and sometimes the exam it has come for just 3-4 marks also. For more theory on this chapter, please watch my SFM theory marathon available on YouTube. I would have discussed the theory question which has come in the examination in the history. Okay. So I hope no questions on this. So this completes the overview or summary discussion on portfolio management. I started from the basics of return, standard deviation, beta, correlation regression, etc. I hope it was useful. Okay, good.